Good afternoon and welcome to this Regulatory Transparency Project webinar. My name is Colton Grob. I'm the Deputy Director of RTP. As always, please note that all expressions of opinion are those of the guest speakers on today's webinar. If you'd like to learn more about each of our speakers and their work, you can visit regproject.org, where we have the full bios. After discussion with our panelists, we'll go to audience Q&A. So please enter any questions you have into the Q&A function at the bottom of your Zoom window. This afternoon, we're pleased to host a panel that will cover what has transpired on the banking front since the panel that we hosted in June on the March 2023 bank runs. We're very thankful to Alex, who's a senior fellow at the Mises Institute, for moderating today's conversation. Alex, I'll pass it off to you to introduce our panelists and kick things off.
Welcome to all of you who are participating with us today in this webinar. We're going to take up the riskiness of the banking system. This story did not end, as we all know, with the runs on and the failures of 3 large banks last spring and the associated bailout of large depositors. A dominant, ongoing issue in the banking system is interest rate risk. As one acute financial thinker wrote recently, quote, "Nothing sedates rationality like large doses of free money. And we've had years of it," unquote. Another recently wrote, quote, "of the illusion of value in a zero interest rate environment," unquote, which we experienced, of course, for years. Well, the free money and the zero interest rates are gone, but their legacy has left a lot of damage on bank balance sheets, as interest rates have moved from lower for longer to higher for longer, as is so often said these days. In the Federal Reserve itself, this change has left the Fed with a mark-to-market loss of over $1 trillion, well over $1 trillion. And the Fed has operating losses of more than $100 billion in the last 12 months. Well, that's the Fed. What will higher for longer interest rates due to the private banking system? In this context, we have to consider that interest rates are not really high. Historically speaking, they only seem high to us because we have lived through the abnormally low period. On a longer view, interest rates are normal. So the real issue is not higher for longer, but normal for longer. Moreover, as is widely discussed, the banking system is yet once again, as it has so often in the past, facing looming credit problems in commercial real estate, exacerbated by the higher or normal interest rates. The combination of interest rate risk and real estate exposure reminds me of how our panelist and my good friend Bill Isaac nicely summed it up some years ago in a speech in Washington, in which he said, quote, "While we weren't looking, the banks became savings and loans," unquote. Now, our excellent panel is going to take up the risks and also the issue of what regulatory reforms would make sense. This involves such questions as mark-to-market accounting, a classic and still lively issue. Would we want to mark all bank balance sheets to market just now, for example? Well, maybe not. A notable study of earlier this year suggested that if we did, the total tangible mark-to-market capital of the entire banking system would be approximately zero. What does that mean? Now, here's another issue. What should the role of interest rate risk be in risk-based capital requirements? It's my view, for example, that the risk-based capital requirement for 30-year fixed rate mortgage-backed securities should be much higher than its current mere 1.6% for Fannie and Freddie MBS and 0 for Ginnie Mae MBS. This is not because of their credit risk, but because of their intense interest rate risk, and it ties into the dominance of the fixed rate 30-year mortgage in the US, which is a unique problem of the United States financial system, and it does not fit well into the international concepts of risk-based capital. As the banking system has become more S&L-like, another issue is how should the federal home loan banks fit in to the overall system? And also, we can consider, do we need fundamental reform of deposit insurance? Can it be a sound principle, for example, that no depositor should ever take any losses? Well, we have a panel of outstanding experience and outstanding insight to address these issues of risk and reform. Let me introduce them briefly in the order in which they'll speak. First will be Bill Isaac, who is chairman of the Secura Isaac Group and was chairman of the FDIC in the multiple crises of the 1980s. Next will be Larry White, who is the Robert Cavish Professor of Economics at New York University's Stern School of Business and was a director of the Federal Home Loan Bank Board in the tumultuous 1980s. Our third speaker will be Keith Noreka, who is Executive Vice President of Potomac Global Partners and their banking practice, and has served as acting U.S. Controller of the currency in 2017. Each panelist will make opening comments from 7 to 8 minutes. We'll give each a chance to react to the others, and then we'll move to a general discussion, including questions from the audience, which you can send in electronically. We'll conclude at 2 o'clock. And Bill, it's great to see you as always, and you have the floor.
Thanks, Alex, and thanks to all the people in the audience whom I can't see, but I know are there, and I appreciate it. I'm very concerned about where we are in the banking system today, and I believe that we need significant reforms and meaningful reforms, which right now it doesn't look like we're lined up to get. Congress is, I think, sort of given up right now, and I don't think they're believing that they can really fix things in this session and in this political climate that we're in. The banking system started off in a very bumpy road. It continues to be on a very bumpy road. Some of you may be not as old as I, but I remember when Alexander Hamilton wanted to create the Bank of the United States, and it went through fits and so forth to do it. And he did get it done, and it had a 20-year charter. That was the original Federal Reserve, and it was part of the plan that they had for a sensible financial system in this country. And Hamilton fought hard, and he eventually got it, but it only had a 20-year charter. Nobody liked it, particularly the southern states were opposed to it, and so it went away after 20 years. And they tried again a number of years later, not too many years later, and with the second Bank of the United States, and it was just an awful fight. And so banking reform, sensible, forward-looking reform, is not easy to get done. And our country basically has said time and again, we will fix it if and when it is obviously broken. And then we're going to fight about how we fix it. And we're probably going to give up and enact some new regulations. We're not going to truly fix it. The structure is wrong. It really is. We have 3 regulators of banks at the federal level. I think we need to reform that. And then we have state banks, and I'm not opposed to state banks. I think that's fine, but we need to make sure that they are regulated properly, and we're not really doing that as well as we could. And we have an FDIC. Finally, it took us a long time to get there. A lot of banking panics before we got there, and that's a good improvement. But the FDIC has been basically misused. It was supposed to be for small depositors, 5,000, 10,000. Eventually, it got up to 250,000 today, but it hasn't, in fact, been used that way. Large banks have almost always been bailed out, and I'm not saying I'm not guilty of it, because I handled Continental Illinois, and people criticize that, and I would criticize it, but I did what I had to do, but I think we can do better, and the FDIC has actually put out some ideas for doing better, And I have written about it as well, and I plan to write some more, and hopefully we'll get that fixed. And so anyway, the controller of the currency was created in around the Civil War, and it was created because we needed a national bank, and the two national banks that the Congress formed were gone, and so we had to do something. We needed a nationally chartered bank, and so we created the controller of the currency to do that. But that was the only change we made then, and we didn't do anything else. We didn't have a central bank until 2000, till about 1913 or whenever it was done, 1905. I don't remember, but we find. Pardon?
1913.
Yeah. And so that's we finally got a Federal Reserve, but it was one reform, and we still left a system that had state banks that were not regulated and properly, and nobody was insured, and the Federal Reserve wasn't sure what its job was, and so we wound up being in the Great Depression. Well, in the Great Depression, we decided that rather than straightening out regulation and the banking structure, what we're going to do is we're going to take the banks and put them in a box, so they couldn't do anything except precisely what we told them they could do. And that left the banks weakened substantially. They didn't have any diversity. They were not geographically diverse. They were not diverse by products, and they also weren't. We didn't allow anybody else to come into the business, but we also didn't allow banks to broaden themselves. So they were in a trap, and they wound up being leveraged with fixed rate loans, because that's what they were allowed to do, and they weren't allowed to branch and get geographic diversification, and so basically it led to a bubble that happened to explode when I was chairman of the FDIC. It began in the 1960s, and then it went into the 70s, and the interest rates were going up and up and up, and banks were in more and more trouble. And so eventually it just all blew up in the 1980s, and we lost some 3,000 banks and thrifts. We lost all the thrifts, and we lost a lot of banks. Continental Illinois being one example, but there are many, many examples. Large banks all over the country that failed in that period. I believe we can fix that system so it works a lot better. I've been writing about it. I'm going to write about it some more, and I'm hoping that when Congress comes back next year, they'll be in a better mood, and things will be more constructive, and we'll be able to talk about these issues seriously. And it really does need serious discussion. We can fix these problems, or at least reduce them substantially. And I firmly believe that, and I'm going to be promoting that as much as I can. Thank you.
Thanks, Bill, very much. Larry, good to see you.
Alex, good to see you. I want to thank the Federalist Society, Colton in particular, for arranging this as a follow-on to our previous session back in June. And I'm really pleased to be part of this session. Now, Alex, in his introduction, mentioned a couple of important things: interest rate risk, commercial real estate loan risk, mark-to-market issues, the Federal Home Loan Bank system and its role. And he talked about deposit insurance reform. I wish he had been a little more direct and said, we have 40% of our outstanding deposits uninsured, and historical experience, including 6 months ago, tell us that makes banks especially fragile because those deposits are flighty. All right, so we're supposed to talk about what's the current state of riskiness in the bank system, what to do about it. The quarterly banking profile, you can download this off the web. It's an FDIC publication. The end of the second quarter, June 30 results came out a month ago, and I'm going to be telling you the important things that you can find. It's a data-heavy publication. 25% of bank equity is wiped out by the unrecognized losses on bank balance sheets. That's the consequences of the interest rate risk. Uninsured deposits, 40% of the overall level of deposits. Commercial real estate loans, 75% of banks' capital overall. And if you look at the small and medium-sized banks, they average 200% of their capital. And of course, these are all averages. There are individual banks that are going to be a whole lot worse on many of these dimensions. So what do we do about this? If I could only choose one, I'm going to mention a number. Alex mentioned it, market value accounting. Alex, that comes as no surprise to you, mark to market. And that is consistent with the Federalist Society's theme of greater transparency, getting more transparency into the bank reporting, call report data system, recognize reality rather than paying attention to some last year or 5 year ago or 10-year ago price that you paid for something. That's not the way you would value your own house. That shouldn't be the way we should be thinking about the value of banks. So if I could do only one thing, that would be it. All right, but I'm going to mention a few other things. And in some ways, I'm very sympathetic to many of the things that Bill mentioned. The problems, and I'm going to offer some besides market value accounting. The whole bank supervisory system has to get more serious, more aggressive on interest rate risk. It is so clear that the Federal Reserve Bank of San Francisco was just not, they sort of knew about the interest rate risk that was lurking in Silicon Valley Bank and First Republic Bank, and they sort of brought it to the attention of senior management and then never did anything. And that just has to be seen as a much more serious issue. As a more overarching suggestion, we've got to simplify capital requirements. For a long time, I thought, just a simple leverage ratio isn't nuanced enough. And I still believe that, but I sure know, 1,097 pages of the latest capital, the Basel III cleanup, I think it's called, 1,097 pages. Give me a break. And there was a law firm that put out a simplified version on PowerPoint slides that runs to merely 230 pages. We've got to find a way to do it all: credit risk, interest rate risk, operational risk, in 30 pages. My guess is the 4 or so people on that are going to be talking today, if we could get our heads together, we could probably come up with 30 sensible pages. 1,087, give me a break. The most controversial thing I'm going to suggest, Alex, Keith, Bill, you already know this. We have a problem with uninsured depositors. In wishful thinking, they are monitoring the bank's management. They're keeping bank's management to doing more sensible things. In reality, they do very little monitoring, but they get nervous at the last minute and they run, and their running causes other uninsured depositors to get nervous as well, and they run. That's a classic negative externalities problem, a classic, pandemic pandemic type problem. So my solution is go to 100% deposit insurance, not because I love the idea of the high deposit level individuals getting off and probably underpaying for the insurance. We've got to address the negative externality in some way. And oh, by the way, if we went to 100% deposit insurance, a lot of the current bank secrecy no longer has a justification. The major justification, Bill, you must have had this. I know I had it when I was at the Federal Home Loan Bank Board, was we can't be more transparent because that would make depositors nervous. They would run. That would destabilize the banking system. We can get much more transparency if we're no longer worried about runs. Again, the Federalist Society is interested in transparency. 100% deposit insurance gets you there. Now, of course, I want more monitoring. I want the regulators to be doing their job a whole lot better. I want things like subordinated debt or other kinds of loss absorbing capital with some governance rights to be able to do that monitoring.
1 minute, Larry, you got 1 minute.
Okay. And I understand 100% deposit insurance, not the most popular idea around at the moment. But I just urge you to think we have 40% across the entire system, uninsured deposits. There are banks, small, medium-sized banks with much more substantial uninsured deposit levels. That just makes these banks fragile, unstable, and prevents the transparency. So if we're not going to do 100% deposit insurance, we've got to figure out some way of addressing the negative externality. Slow down the withdrawal process, put gates in place, recognize that perfect liquidity and perfect safety are simply not compatible in a banking system. Do something. 40% makes the system fragile. But if you'd like to know how I really feel about this, Alex, I'm through.
Thanks, Larry. Okay, we're going to go over to Keith. I can remember visiting Keith when he was controller of the currency and seeing a copy of the original handwritten version of the National Banking Act up on his wall. So Larry, maybe
I love that. I wish I had a copy as well.
Maybe, I don't know if it was Keith's or it belonged to the office, but anyway, maybe an idea would be that no bank capital regulation could be longer than the original National Banking Act. Anyway, Keith, great to have you.
All right, well, thank you very much, Alex, and Larry and Bill. Great to be on the panel again with you. That law it actually belongs to the office, signed by Abraham Lincoln, two acts, one of 1863 and another of 1864. So look, I think the topic today, I think Larry stated it well, sort of where are things and what should we do about it, if anything. My own view is like we haven't even gotten yet to the credit cycle. Like we've been through this interest rate risk dislodgement in the spring, which brought us together then. Just to paraphrase Donald Rumsfeld, right? Those were the known knowns, right? And now we're off to the known unknowns, which is the credit book of these banks, which is inherently not transparent. That's why you have banking regulation that's different than all other regulation in the first place. And then there's the unknown unknowns, right? Which is what do you do about it? Which is in a fluid environment. Just as far as the credit cycle goes, before we move on, we're seeing a lot of stress in, say, the leveraged lending market. I mean, interest rates are approaching 20%. Like how high and how long does that go before things start breaking? And what's the exposure on the banking industry? So, one of the things that I'm going to talk about in a minute is the banking industry itself is a lot different than it has been in the past. assets under management of private equity, for instance, is now eclipsed that of the banking industry. We heard from Bill the story about S&Ls sort of being put in a box, and now the banking industry becoming the S&L industry. How long before we don't talk about the banking industry anymore because it's gone by the wayside like the S&L industry? So, there's a lot going on, and I don't think it can be looked at in a vacuum. The banking industry is one part of it. It's used to maybe clear transactions and provide some leverage, but it's dynamic and it's changing with respect to its competitors for capital elsewhere, right? And so when you look at the whole system of financial intermediation, you see things like private equity really cleaning the clock of both the public markets and the banking industry itself. And we have regulators who are very laser focused on one thing and one thing only, their industry, and not being held accountable for some blow up. But if the effect of that is driving their industry out of business, then we have we have something else to maybe consider going forward. So I think, look, the way one of my predecessors put it to me early in my career, even before I was at the OCC, was, Keith, the bank regulators regulate for safety and soundness. And he's like, a lot of times soundness gets shunted to the side, but soundness sort of goes into that. What is the business model of the industry? What do we want it to do? And how do we want it to do it? And what type of return do we want it to achieve? Because that third part is how you attract capital to it. And if other industries can attract a lot more capital because they can offer safer returns at a higher rate, then the banking industry is going to have to do something else, or shrink, or become a public utility, or you need to redesign the banking industry in a way that it can achieve its purpose of financial intermediation without the risks presented. So I think, at some point, we're going to have to, have a, Treasury Commission or even a presidential commission to, think about what the banking industry is for, where it should be going in light of everything else, and not, in this sort of, hot pressure attitude of, there have been failures and there will be failures. I mean, I think we're going to have more failures, where, the attitude of Washington seems to be come down like a ton of bricks. I think what you're seeing right now from the regulators, even with these large capital proposals and the like, I mean, those were already in the works, right? They're just being, repurposed as a solution to a problem that didn't exist at the time they came up with these proposals. And the idea that I think even the current regulators will realize that you can't come down like a ton of bricks on the industry, or else it will collapse underneath it at the moment. And so that's a challenge, right? We're getting to the hard question, I think, of the nature and future of the banking industry. And I think what you have to figure that out before you can have any type of legislative proposal to deal with it. I mean, there have been, for instance, if you really go back and, people like Alex, Bill, you'll remember this, Larry. I mean, there were proposals for, say, like a narrow bank, right? Where you wouldn't even need insurance. You would be fully collateralized. Maybe we need to sort of pull out some of the old thoughts and think about them a little bit more of the nature of it. Because again, if something like private equity is better because the people who are funding it can't run. And again, that's a big if. I'm making an assumption there. I don't have any data to support and may not be supported. But if it is, then maybe we should kind of move that way, for the making of non-transparent loans that have to be carried at cost, or, it's hard to mark to market, and, we'll get to that, and then move the transactional runnable, things off to something that's maybe a little bit more transparent and liquid. Again, I don't, I'm just throwing ideas out there. I think this would be sort of a long, involved process, but, we certainly have I think we're sort of getting to be at an inflection point where we can, have that conversation. So with that, I'll turn it back over to you, Alex.
Thank you very much, Keith. Let's go back through the panel in the same order. Now you have 2 or 3 minutes to respond to anything anybody else said or add something else you want to add. So Bill, you're first.
I have so much I want to talk about. I'm not sure how I could do
You
it.
got 3 minutes. You got 3 minutes.
No, you got to give me at least 3. Let's negotiate. Anyway, some very interesting comments have been made, and I just want to touch on them. First of all, Larry talks about mark-to-market accounting, and Alex did too. I want to tell you that I am absolutely unconditionally opposed to mark-to-market accounting. That's a big part of our problems in the banking system, has been since 1980s when the S&L industry blew up, because in large part because of mark-to-market accounting issues. They were underwater, and interest rates went up to 21.5%. 21.5%. The Fed raised the interest rates to, and no S&L and very few banks could actually survive that if they were doing full-blown mark-to-market accounting. And to me, we'd be out of our mind to submit ourselves to market regulation to that degree. I mean, I know that because interest rates, they change. And nobody. I mean, the people who are setting those interest rates are worried about tomorrow and the day after tomorrow, not a year from now or 2 years from now. And they are bettors. They are heavy bettors, and they're gonna destroy whatever's in their path. They make a lot of money having banks fail, or other firms fail, and we can't let them run the country and its financial system. And so I'm absolutely 100% opposed to mark-to-market accounting, and I, for the same reason, I'm absolutely 100% opposed to 100% deposit insurance.
Bill, let me interrupt just before you go into that. I put that mark-to-market up there on the list because I knew that you and Larry would come out in interesting opposition. And I thought that would be fun. All right, let's go on to 100% deposit insurance.
Yeah. By the way, you just used 2 of my minutes. So I'm taking them back. Anyway, 100% deposit
I
insurance.
want to have your kind of ruler that goes from this all the way out to that, Bill.
I don't know what that-
Hang on.
I don't even know what that
You're going to
means.
turn next. You got to turn.
I don't even know what that means, so I'm going to ignore it. But in
You
any event,
still have 2 minutes, Bill.
okay, I've got 2 minutes. All right. 100% deposit insurance is a terrible idea. We have trouble enough disciplining the system when you've got $250,000 deposit insurance, and we can't can't regulate enough or examine enough to keep on top of the situation. I think that the answer is, and I'm posing this, is to make sure that we cause some loss to the big depositors. They don't really have to take huge losses, but they have to be punished for having their funds sit in institutions that are not safe. And so I do want to reform the deposit insurance system, and we can reform it to make it a whole lot better than it is right now. And I have proposals to do that. Subordinated debt, Larry mentioned, and I don't want him to think I'm picking on him because I actually favor that. I think that's one of the things we should use to discipline the big depositors and the reckless acts that some banks might undertake. We need subordinated debt in the picture, and it should be significant. Smaller banks probably can't reach the market, but I can tell you that when I started my career at a law firm, and I was representing a large bank, and it made a lot of loans to correspondent banks. And one of the things they did is that large correspondent bank bought subordinated debt from those banks, and that was a great way to control reckless behavior, because those banks that are loaning that money, or insurance companies that are loaning that money, are going to help the FDIC and the regulators control the behavior of that bank. That is an excellent idea that I favor. I also think that, do I have any time?
No.
Okay, I give up. I'll have more time later.
You will. Okay, good. Larry.
All right.
Actually, I take that back, Alex. One other thing I want to say: Congress causes most of this mess. They do not have control of the budget. And the Fed can't take control of the monetary policy very well with the Congress spending bazillions of dollars that it doesn't have. And so we wind up with very, very high interest rates and interest rate volatility. So Congress is a principal cause of these problems we're having. And we need to fix that too. And I'm done.
Okay, thanks. Larry?
All right, Bill, pleased to hear we're on the same page of subordinated debt. Great. And I was really disappointed. Sub debt or loss absorbing somethings was actively talked about after 2008, and it's just disappeared from the conversation. We got to get it back.
The FDIC did that internally, Larry, after the 1980s. We proposed sub debt, and the next administration didn't carry it out.
Well, all right. As I said, I understand 100% deposit insurance is not the most popular thing on the table. 40% uninsured deposits make a banking system fragile. That there's this negative externality. I hear that Alex is pulling his money out of his bank. I get nervous. I don't understand my bank, but man, if Alex is pulling his money, better safe than sorry. I better pull mine. And we have a negative externality process. We've got to address it in some way. We can't just pretend it, put our heads in the sand. That was at the heart of what did in on that Thursday, March 9, did in Silicon Valley Bank. $35 billion running with another 65 billion scheduled to run the next day. Let me just say, Keith, anytime, you didn't endorse this, but man, anytime I hear somebody say, well, geez, maybe we ought to turn X into a public utility, and banking is now being talked about. There's a law review article somewhere that's going to be coming out. Public utility, man, we have enough trouble trying to regulate a relatively simple entity like an electricity company, distribution company, or a natural gas distribution, or a water distribution. Why would anybody think that, public utility? Again, you didn't endorse it, but I know it's out there on the table. Presidential commission, yeah, probably a good idea, but let me remind you that during the 1970s, there were at least 3 commissions, all of whom brought in recommendations that said the savings and loan industry that can only borrow short and lend long is a disaster waiting to happen. It needs to be reformed. We need to give them more flexibility on the kinds of loans they can make and what they can do. And it got totally ignored until the crisis of 1979 happened. And then Congress decided, before they could say it ain't broke, we're not going to try to fix it. Now, suddenly in 79, they saw it was broke. They had the Depository Insurance, the DID-MCA Act of 1980, and the Garn-St. Germain Act of 1982, both of which were sensible, but were way too late. Had they been done 10 years earlier, I might not have had the opportunity to write a book about the savings and loan debacle. So I just, alas, and this is partly what Bill was saying, we've had for a long time Congresses that have the ethos, if it ain't broke, don't fix it. And they have a lot of trouble seeing that anything is broke until the water is absolutely gushing down on top of their heads.
Good stopping point, Larry. Thank you very much. Keith.
All right, well, thank you. Great discussion. Just a couple of things to react to. I guess mark to market. I mean, I would wonder if there's a distinction to be made between a bank securities portfolio versus its loan portfolio. securities portfolios much easier to mark to market. I think loan portfolios much, harder, and, gives rise to judgment. And, so I just sort of throw that out there of, there may be a distinction to be made, maybe not, if you're Larry and you want full transparency. 100% deposit insurance, at least to me, seems like a bad idea. You are taking whatever, private monitoring function, and you're substituting the government. So, I mean, what's the difference between that and nationalizing the banks? Fiscal deficit, I agree with Bill. I mean, I think that's kind of behind all of this. The Treasury is pumping, and the Federal Reserve tons of public debt into the markets that has to go through the banks, and the banks are the intermediaries of first resort. And when that changes, they're the coupler holding the railroad cars together, and there's going to be a lot of stress between them. I know, Alex, you've written about decoupling from the gold standard, and this is sort of where we are, right? Like 40 years later, we have money that's just backed by the full faith and credit of the government, and we have sort of a droit extraordinaire, right? Like the our legacy of the reserve currency that allows us to live way beyond our means that other countries don't have. And all that stress comes through the banking system. And if there's going to be financial pressure or eventual financial distress, it's going to go through the banking system. So in some ways you can't talk about that in a vacuum or in a bubble, divorced from what Congress is doing as far as, and the administration is, as far as spending beyond their means. And finally, I mean, I certainly don't endorse the banking industry as a public utility. I think that's more why I'm thinking about different ways to structure it. I mean, the fundamental weakness of the banking industry is this runability, right? You have short-term liabilities and long-term assets, same as the S&L industry, but maybe a little less exacerbated than it was then. But if you're going to find a way to perhaps decouple that to make it safer, then you don't need all this regulation, and you can have a privately ordered system of financial intermediation. So I'll just leave it at that.
Okay, thanks, Keith. Thanks all for a very lively and very obviously knowledgeable conversation. I want to go along to some questions from the audience who are paying attention and who are writing in. This is going to change the topic a little bit. This is a question from Wayne Abernathy. We have 3 experienced senior regulatory officers on the panel, and Wayne knows a lot about this, as we know, through his own experience both in the Senate and with the American Bankers Association. He writes, financial regulators are expected to be nonpartisan. They admit they missed a lot with regard to the recent failure of the large banks this spring and were caught by surprise. The business geography of these large banks and their customers is hard to overlook. To what extent were the regulators susceptible to political influences in the supervision of these banks? And in general, how should reform avoid partisanship in financial regulation and supervision? And that's a question anybody can take up once.
Well, Wayne is a good friend, and I've known him a long time, and he's spot on with his question. The system, in my opinion, has become more politicized than it should be, and I think we need to change that. And one of the proposals I'm making is that we have the controller of the currency taken out of Treasury and turned into a federal banking commission. And it was a member, 5-member board. The Fed gets out of bank supervision and regulation and has a seat on that board. And the FDIC give up its supervisory powers, except the oversight of the regulators and the job they're doing in banks. In other words, the FDIC has to have oversight. Somebody has to be looking at the system and make sure it's working, and that would be the FDIC. But the FDIC doesn't need to be approving branches and new charters and all that. And so I would have it as a member of that commission, and then I would also have a deputy secretary of the Treasury as part of that commission. And then there are two presidentially appointed board members, the chairman of the FDIC and the vice chairman, and they're opposite parties. So that's what I think.
That's your unitary regulator.
Yeah, exactly. And then I think that system will get a lot of the politics out of banking, bank regulation. And I think it's really needed, desperately needed. The president should not be involved in deciding how bank failures are going to be handled, nor should the secretary of the Treasury. We have professionals that can take care of that, and they report to them. They can tell them what they're doing and ask their opinion and so forth. But they shouldn't be, the president and the secretary of the Treasury shouldn't be involved in those decisions. It's a mess. It really is. It's hard enough to handle big bank failures without that interference, and it'd be impossible with it. So those are my thoughts on that subject, Wayne, and thanks for bringing it up.
Other comments from anybody?
I guess I would disagree with that, right? I mean, we have, the most political agency, the Office of the Comptroller of the Currency, has, at least to date, knock on wood, been the most successful, with the banks that have faced stress. I mean, we have the Federal Reserve and the FDIC as the primary regulators for all of the banks that have failed recently. So this expert approach, I don't think necessarily works if there's no accountability attached to it, right? And at the end of the day, you have to have political accountability for, the voters. You're spending their money. The least we can do is give them a say, in that, in some respect. So, I think it's fine. Like, I mean, that the president of the United States has to, or the secretary of the Treasury, if you're going to be, spending hand over fist of the taxpayers' money, that maybe the voters should have, some accountability to these people. And, I think it's a false idea that the bureaucracy doesn't have any political views. I think, in many ways, the bureaucracy's number one goal is to perpetuate the bureaucracy, right? And they will do that if it means aligning with a political party to save them. They'll do that. So I think, you have to be a little bit realistic about the way Washington works. I think, part of the problem, I am very sympathetic to, your concerns, Bill, and I think there's a lot right. I think probably a lot of it emanates from over-regulation. If you have a regulation that makes everything a violation of law, and you give people discretion in how they enforce it, they will use that to advance their political interests. And I think they're seeing that, in the banking industry and elsewhere, where that's striking people as unfair. But I think at the end of the day, that's probably the result of too big of government, right? I mean, you do too much, and then you give people discretion in how to enforce it. There's bound to be unfairness in how things are applied.
Let me say a couple things. Let me say a couple of things, Keith. First of all, I think the controller of the currency has been an excellent regulator for the most part. That's why I selected it to be the regulator. That would be the tent that holds the regulatory stuff. I just don't like it accountable to politicians. I really don't. And I speak from a lot of experience. I know what politicians at the Treasury and elsewhere were trying to get me to do when I was chairman. And fortunately, I'm not a very political person, so I ignored it. But a lot of people don't ignore it and can't ignore it. And so,
hang on, gentlemen, this is good. We could have a whole conference just on this very good question.
Next time, Alex.
Hang on. We need to go on and give other questioners a fair chance here. So I'm going to go on, and let's hold this. Maybe the next time we get together, we'll give this more.
I see there's another panel coming down the line.
Because it's certainly an important question. But here's another important question. And I'm going to make a comment here, give you the question, then I'm going to make a comment, then open the floor. The question is, how do you pay for 100% deposit insurance? It's a very good question. And my answer is, part of the way you'll pay for it is by having an exceptionally risky financial system Henry Thornton, writing in 1802, an inquiry into the paper credit of Great Britain, said, if you make it clear to the bankers that the Bank of England and the Treasury will always rush in to bail out the system from its mistakes, the banks will engage in the very risk which will bring the system down. I think that was right in 1802, and I think it's still right. But I've opened the floor to the panel to comment. And Larry, since you missed out last time, maybe you want to comment on how do you pay for 100% deposit insurance?
Sure. And, at the beginning, you have a much better risk sensitive deposit insurance system. Think of deposit insurance as insurance. And how do insurers keep going? Partly they levy premiums on the beneficiaries, potential beneficiaries. Also, they establish rules to protect themselves. And the right way to think about prudential regulation, or as Bill and I used to think or say in the olden times, safety and soundness regulation, and Keith, you brought that up as well, that the way to think about safety and soundness, prudential regulation, it's the rules that protect the deposit insurer. So if you have a good set of rules and a good set of deposit insurance premiums, the amounts, yes, there will be the occasional bank that does go bust, that there is the occasional payout to the insured depositors, 100%, but that better premiums and thinking about safety and soundness regulation as the rules the insurance company puts in place to protect itself.
So should we have a private insurance company set the rules, set the premiums?
Well, if Goldman Sachs were providing deposit insurance to bank depositors, I am sure they would be thinking quite carefully about what kind of rules they would have in place to protect themselves. No question in my mind.
I think that's an absurd idea. I really do. And there's no way to have 100% deposit insurance without nationalizing the banks. And if you nationalize the banks, we have lots of experience with that around the world. It's destructive. It's very destructive.
It's always a failure. We know that.
It's always a failure. And by the way, the FDIC has the power right now to set premiums, risk-based premiums, and it uses it to some extent.
Okay, we're going on to the next gentleman. This is terrific. We could have a whole conference just on this one. I want to go to the next question. The Supreme Court is hearing, this is from Steve Dewey. The Supreme Court is hearing a case tomorrow on whether the CFPB's funding by the Fed set up under Dodd-Frank is in violation of the appropriations clause of the Constitution. If the court rules that CFPB's funding is unconstitutional, what happens then and what does it mean for the banks? Anybody want to take that one on?
I think it's a great idea and it'll help the banks, and the Congress will do what it should have done, which is they'll put a proper governance in place for the CFPB instead of a single individual. And that individual will have to go to Congress and ask for money. So it puts that agency under some sort of reasonable oversight. And that's what Elizabeth Warren didn't want it to have.
But Bill, I'm not a lawyer. I would never practice law without a license. But the bank regulators get an appreciable amount of their revenue through levies on the banks, and not through appropriations from Congress. I think that's where that question is directed. If the CFPB funding process is suspect, how about the funding process for bank regulators more?
The CFPB is taxing the Fed, not the banks.
Yeah.
And there's no control over it whatsoever.
Yeah.
At least the FDIC has banks that are unhappy when their premiums go up. CFPB doesn't have to worry about it.
Yeah, there's no check. I think the other bank regulators have some check. The OCC, you can just change your charter to a state charter. FDIC, you can change around, your deposit premiums and the like. With the CFPB, it does seem. I mean, you're getting into more metaphysical questions, and we'll see what the justices come up with. But I mean, it was funny when that was first enacted. I'm surprised it's taken this long to get to the Supreme Court. I always thought the same people, proposing this, imagine Don Rumsfeld had, been a bureau of the Federal Reserve and can fund himself just by writing himself a check to run the Defense Department and war. Somehow, I think a lot of people might not be okay with that. And, it doesn't, get better just because it happens to be a pet project of a certain, fringe political groups.
Thank you. Very good. Now we've got 3 minutes left, so you're each going to get 1 minute on this next question. Which I think is a very good one to end on. It's Ned Headley writing in, and he says, would each participant give just one legislative proposal? We've heard some already, but now you get the chance. And what's your top legislative proposal to help solve some specific problem? So shall we go in the same order? Bill, what's your top one legislative proposal? Is it your reorganization of regulation?
Well, certainly I favor that. That should be a very high priority. We've got to fix the financial system. But number one, kill inflation, stop it. And that means get these deficits under control. That's it.
Thank you. Larry, one top legislative idea.
I'll come back to mark-to-market accounting. Increasing transparency, increasing, it's not like suddenly a bank wakes up and, oh my gosh, I have to mark, once the culture of, if I buy a long treasury and interest rates go up, I'm going to have to show that on my balance sheet. Geez, first, maybe I ought to think twice before I buy that long treasury. And second, if I still want to do it, I've got to hedge. And so a culture of hedging would also accompany the market value accounting, mark-to-market accounting.
The only adjustment I'd make to that is they're much more likely to be buying a 30-year fixed rate mortgage-backed security, which is much harder to deal with than say a 10-year.
Fine, even more so. But there are hedges. You can get hedges. Silicon Valley Bank had hedges and then let them all run off during 2022. I mean, how could that happen?
Okay, great. Larry, Keith,
All
1
right.
minute. What's your top legislative priority?
Same as Bill, have a budget, first of all, for Congress and then try to balance it. I think if you did that, the whole industry would be in a lot better place.
Okay, thank you. And you have been extremely interesting, not to mention entertaining panel. Thank you all very much. And Colton, we'll go back to you for the Federalist Society close. Great panel. Thank you again.
Thank you, Alex, for making it happen.
Excellent. Well, I just want to echo Alex's comments. This has been another amazing panel, and I do think that we would love to have you all back to discuss a couple of these issues in more detail. I think that they definitely warrant it, and our audience certainly would appreciate it. For those of you in the audience who joined the conversation midway through, you can watch the recording via YouTube or listen to it via your podcast feed, and it should be available everywhere you listen to podcasts. We welcome listener feedback by email at rtp@regproject.org. With that, thank you for joining us. This concludes today's discussion.